This video will cover stock indexes. We'll cover some background. We'll review 3 types of stock market indexes, and then we'll look at replicating indexes and tilt strategies. Now, let's get a little background. Why look at indexes? Well, you're probably used to hearing about stock indexes on the news, for example. You hear the Dow Jones Industrial Average is at 29,000. What does that mean? What is the Dow Jones? And then you'll hear about the S&P 500. It's like, what is that index? What is it? Well, that's what this video is going to talk about. Indexing is really important to investment management. Nearly every investor who has money, has put money in the stock market, wants to know, how am I doing? How would you answer that? Well, you answer that by comparing it to a benchmark index, usually a market index. And a market index represents the average stock. Now, as you know, averages can be computed in different ways. Averages can have certain weights or they can have equal weights. You can manipulate the weights, but the weights ultimately have to add up to 1. Somehow, some way, you have a certain amount of money and you're putting 25% in one stock, 25 in another, and then 50 in another. That adds up to 1 or 100%. So it's the weights that are important here in studying indexes. And that's what differentiates one index from the other. It's how is it weighted. So you want to know how your portfolio is performing. And not only that, but maybe you want to actually mimic an index. Maybe you have a client that wants you to mimic an index. Well, how would you go about mimicking the S&P 500? Well, you have to know how much weight to put in each of the 500 stocks. Or maybe you want to mimic the Dow, which is 30 blue chip, well-known company stocks. And you'd want to know exactly how the weights are there. And not only that, but how would it perform over time? Do you have to make any adjustments to it? Those are important questions. Not only that, but there's a whole stream of literature on index investing as a strategy or style of investing. And what do we mean by that? Well, there's a lot of literature that shows that, in empirical research, that shows that the average investor underperforms the market. So wait a second. The average investor underperforms the market. Well, if the market is an average stock, how can the average investor underperform? Well, at least the typical investor underperform. Here's how it goes. Often, when the stock market is booming, people hear about it, it's in the news, and people want to get part of the action. So they buy into the market when the market's up. So they buy high. Then, ultimately, when they buy high, and after all that frenzy is going on, the market drops, and they get frustrated and they sell. Okay, the bad news, they get scared, they get nervous, they say, I made a mistake, and they sell. So what did they ultimately do? They bought high and sold low. And so that's a problem with human beings and investing. They're often trying to catch the latest stock, and they're often late in doing it. So that's where index investing comes in. If you can't beat the market, why not join the market? And then if you're joining the market, you have an advantage, all else being equal, because the costs are lower. So to have a portfolio mimic the Dow or the S&P 500, it basically requires a computer to do that. There's no active portfolio manager trying to beat the market and actively trying to outperform the market. That requires a whole bunch of portfolio analysts and security analysts that are quite expensive. So if you buy into an index fund, for example, an ETF or a mutual fund, the costs will be lower. Not only will the transactions cost be lower, and that's generally not a huge part of a cost of a mutual fund, but the portfolio manager expenses just won't be there. And so that's where the costs really come into play and are reduced when you look at index investing. So now with this background, let's move into the 3 types of indexes that are out there. The first one's going to be a price-weighted index. So we're going to start off with a price-weighted index because it's the easiest to compute. And not only that, it's been around the longest, and the most popular index in the world, the Dow Jones Industrial Average, is a price-weighted index. Now, there's a reason why it's a price-weighted index, and here's the story as it goes. Back in the 1800s, late 1800s, Charles Dow wrote a newsletter, a stock market newsletter that tracked the market. and the various stocks in it, and he sold it for money. You know, that was his business. He was writing up the stock market. So people used to stop into his office, which was in the Wall Street area, and they used to ask him, well, how did the market do? And the best Dow could do is, stock A did this, stock B did that, but he didn't really have a good handle on how the overall market did. And then it occurred to him, wait a second, why don't I just compute an average of the stock prices each day? And if I compute that average, I can see how the average changes each day over time. And that'll give me an idea whether or not the market went up or it went down. So that's how the Dow Jones Industrial Average got started with Charles Dow, him and his newsletter. And that newsletter ultimately turned into the Wall Street Journal. So what did Dow do when he started that index? Well, he didn't have calculators. There's no computers in the 1800s, so he did it by hand, pencil and paper. And what he did was he took a group of stocks that he thought represented the market, added up the prices, and divided by the number of stocks. What could be simpler than that? And that's exactly what he did. So if you look at what a price-weighted index is the sum of the prices in the index. That's what sigma is, the sum. P is the price of individual stock I, and you divide it by N, which I'm going to change to a little d in a second here. But what it means is you're going to add up 30 stocks across the top, 30 Dow stocks in this case, in the world today. In the world today, there's 30 Dow stocks. It's been like that for a long time. When Dow first put this index together, I don't believe there was 30 stocks. There was much less than 30 stocks. But now there's 30 blue chip stocks. And so you're going to add up 30 prices and divide it by N. Just like, professor gives you a quiz. You want to know what the quiz average is? Well, you add up the 30 students that are in the quiz and you divide by 30. And so it's pretty easy to calculate the quiz average. And pretty easy to calculate a price-weighted index here. So it's an average of stock prices. Let me move on to a value-weighted index, at least show you the formula for it and discuss it briefly. Then I'll give you an example that compares and contrasts price-weighted indexes versus value-weighted indexes. The second most popular index out there, in fact, it may be the most popular today, and that is a form of different types of indexes. When the world of finance creates new indexes, and you can just create one yourself, make your own index up. They're value weighted, and value weighted means the weights of each company depends on the market value of that stock relative to the market value of the entire portfolio of stocks that are in the index. Let me explain. So we're going to look at a sum, and we're going to look at the sum of stocks stock I at time t, and we're going to multiply it by Q at I times t at time t. P times Q is the market value of the company. It's price of the stock times the number of shares outstanding. So this is often in the billions for each stock. And we're looking at it at a point in time t. So you got a timeline. This is time t right now. Think of it as now or at any point in time. That's what this T subscript. I could say it is now if time is 0, but any point in time. It's the sum of all the market values of the stocks in the index. So if you're looking at the S&P 500, which is the most popular value-weighted index out there, then you're going to take 500 of these numbers. It's going to be in the multi-trillion-dollar amounts. Okay, but now we need to scale it. And we need to scale it relative to what did the market caps look like. Sometimes this is called market capitalization of each company. And then when you add all 500 of them for the S&P, for example, it's the market cap of the entire market. Okay? And so we can compare that by dividing it by the value of the index, or the market cap of the index at some base period. So you take the price of each stock I at a base period times the quantity of shares that were outstanding at the base period, right? And you get this number here. You get this fraction. Now, when you first start an index, let's say you start an index right now today, you're going to calculate all the market caps that are in this index, right? And that's going to be as of today. t time is today. And then since this is the very first day you're starting the index, the base is the same period as time t. So in other words, this number is going to be the same as this number. It's going to be 1. So when you start a evaluated index, it always starts at 1. People don't like it to start at 1. It's a little weird. So what they do is they want it to start at some nice round number. And so they multiply it by k. And k is often 100. So the index starts at a nice round 100. And then if the next day the index is at 102, well, that's pretty easy to see. It went up 2%. So this is how evaluated index is portrayed. Now, with a price-weighted index we just looked at, what drives the index is the stocks with the highest price have the most weight. It's because those stocks, those big price stocks, have the most weight. Price-weighted indexes are driven strictly by high-priced stocks. And price by itself, the price of a stock doesn't mean much, because companies can play around with the number of shares they've issued. If you got a big company and they only issue a couple of shares, then the price is going to be huge, right? And that stock will get a really big influence on this, have a really big influence on this index. Well, you can also have the same company with the same value, but it issues millions of shares, and the prices are much lower for each share. And then that stock would get very, very little weight in a price-weighted index. With evaluated index, it solves that problem because it's not just price, it's price and quantity, it's market cap that matters. So it's the relative size of the company, which is why evaluated indexes are often compared to the economy, because the biggest companies with the most market cap, in theory, have the most influence on the overall economy. Or maybe you can look at it the other way, the economy has the most influence on big companies. And so when people look at the stock market and try to tie it to the economy, probably the evaluated index is the most appropriate. Price-weighted index, again, it's missing half the information that you really need. So that's evaluated index. Now, let's actually go to an example. So here we have written it out, and there's stock A, B, and C, and here's the price and the quantity as of December 31st, X1, first year. And then we got the price and quantity as of December 31st, X2, 1 year later. And we're going to assume K is equal to 100. And then now the question becomes, compute the price-weighted index and how much did it change by, and compute the value-weighted index and how much did it change by. So we're going to assume that these three stocks represent the market. Now obviously 3 stocks aren't going to represent anything, but we're not going to be here all day trying to do a calculation for 500 stocks. We'll keep it simple, and you can extrapolate out in your head how this works with 500 or 30 stocks. So the first thing we want to do is let's look at a price-weighted index at period 1, or X1, year X1. And that's simply going to be the sum of the prices, 100 plus 50 plus 20 divided by 3. And that equals 56.57. Oops, so there's our index, 56.57. That's the average of these numbers. Now, what's the price-weighted index in X2? Well, it's going to be the sum of these. And that is 59.33. Ooh, so the market went up, right? And you do a calculation, that's 4.69% growth in the stock prices. Remember, that's what's happening here. It's an important point, that stock indexes, all else being equal, unless it tells you otherwise, it's just tracking prices and not the cash flow component of total returns. They're price indexes. That said, there are some indexes, like for example, there's an S&P 500 index that's called a total return index. It'll say right in its name, total return. That means it's not only tracking stock price changes, but also the cash flow component in computing total return. So the return will be a bit higher because the S&P, it throws off and generates a dividend yield of about 2% or so. The same with the Dow Jones. The Dow Jones Industrial Average, they're blue chip stocks. And so that's another important point. When we're looking at price weighted index like the Dow Jones, it's 30 industrial stocks that are very well known. They're household names. It's Disney, it's Microsoft, it's Apple, and so on. And so those companies have been around a long time. They tend to pay decent dividends. The Dow Jones Industrial Average is tracking just big household name companies, international, in a lot of cases, trillion-dollar companies. So now we're saying, look, back to the story here with price-weighted index. It grew at 4.69%. Now let's calculate evaluated index for X1. And that's going to be 100 times 5 plus 50 times 45 plus 20 times 180 divided by, what are we going to divide it by? The same thing, because we're going to assume we're starting the index in year X1. So we don't have any other information. We don't have any information prior to this. So we're going to start the index at X1. And so it turns out the base period is the same. It's the same numbers. So this is equal to 1. Okay, this is the market value of all three stocks divided by the market value of all three stocks at the same time. That's 1. But remember, we have K of 100 here. So you multiply it by 100. And what do you get? Well, 1 times 100 is 100. So that's quick and easy. What it means is, if you have to calculate evaluated index and on the very first period, at the base time, it's always going to be equal to K. Whatever K is, that's it. You don't have to do any calculations. So you think, oh man, I got to sweat it out and calculate this. First of all, it's not that hard, but it's easy to make a mistake. Don't worry about it. Put 100 in for K. Now, the next period, you're going to have to do calculations. Okay. And so what we're going to do is we take P times Q, add it to P times Q, add it to P times Q. And we're going to divide it by whatever this base period, these base period numbers here. And so that's going to be 100 times 5 plus 50 times 45 plus 20 times 180. And it's all times K of 100. K doesn't change. It's fixed, by the way. And so we do this calculation. It comes out to be 95.12. Okay, 95.12. That sounds good. But wait a second. This gained 4.7%. This lost of 4.888%. Well, which is it? What happened? Well, let's yank this apart here and figure out what's going on. With the price-weighted index, the stocks with the highest price, the stock with the highest price, got the most influence on the index. And what happened to that? The price went up from 100 to 110. So that 10% change is going to have a big weight in this index calculation. This stock remained the same, B, and it's a mid-sized stock. It didn't change, 50 to 50. Okay? And then stock C went from 20 to 18. That was a 10% loss, but it's a small stock. So prices is what matters in the price-weighted index. And so since this was a high-priced stock, it got the most influence on the index, and that's what caused it to go up. Now, evaluated index, it's the stocks with the most market cap have the most weight. And it turns out that stock C has the biggest market cap, right? It's much bigger than A. And so when you have evaluated index, this stock with the loss of 10% had the big impact in what drove the stock market index down here, okay, compared to a price-weighted index. So as you can see, it's all about the relative weights that are there. And that can explain why in some cases, while the market goes up, like the Dow will go up one day while the S&P actually drops. Most of the time they're highly positively correlated, but occasionally they'll pull apart, and it's often because, well, there's different weights, and there's also different stocks, by the way. But sometimes those weights by themselves have an influence. Because some of the stocks that are in the Dow are also in the S&P, so there's overlap in there. And so you have the same stock, right, in the Dow, and the same stock in the S&P, but there's different weights for that stock in different indexes. Let's look at another thing. I mentioned a little while ago, back on this slide, that, this is a price-weighted index. You add up the prices, divide by N. But, when I'm writing this, I really want to put a D in there, and that's usually the way it's specified in most textbooks. Because when you first start out a price-weighted index, you'll divide by N. But you know what happens over time? Especially, think about it. Go back to the 1800s. Charles Dow puts together a Dow Jones Industrial Average Index. And, I think one stock is still around, and that's General Electric. All the other stocks have, they've merged, they've gone bankrupt. The concept of creative destruction, which is new technology coming in and destroying old businesses. So, what are old businesses? Well, if you go back to the 1800s when Charles Dow put that together, well, the big businesses were railroads, and now they're a much smaller part of our economy. Not only that, but there was, companies that made wagon wheels and buggy whips. Well, they're no longer around. So my point is, over time, the composition of these indexes has changed. There are not portfolio managers, or in a sense they're portfolio managers, but there are committees that oversee the composition of every index. An index doesn't drop out of the sky. It's created, like Charles Dow did. For example, the S&P. But what goes in the S&P 500? There's thousands and thousands of stocks. Somebody has to look over and make the rules up as to what stocks represent, say, the S&P and what's going to be in the Dow. What's a blue chip stock? Well, people decide that. And so what happens is they decide the composition, but over time, stocks merge, they acquire other businesses, they go bankrupt, and the composition changes. Well, if the composition changes, you don't really want the index, this index here, this price here, this index value, to change just because the composition is changing. So what I'm saying here is that stocks come in and out of the index. There are also stock splits, which are common. So think about it. What happens when you have a stock split? Well, if it's a 2-for-1 split, there's twice as many shares with half the price. You won't want, so in other words, P for that stock would drop in half. You don't want the index to drop because of an accounting gimmickry. Splits are just, it doesn't change the market value of the company. So you have a company and you have a balance sheet, and here's its assets, here's its liabilities, and here's the market value of its equity, P times Q. That's the market cap. So with a stock split of 1/2, right, or 2-for-1, the price gets chopped in half. There's twice as many shares. It did nothing to the value of the company. It's just a accounting gimmick. So therefore, what happens is when stocks split, and that's probably the best example, when a stock splits, right, we don't want this index to change that at that point in time. We'll just change the divisor to keep the index the same. And let me give you an example. It'll make more sense. Suppose at X2, point X2, stock A goes and has a 2-for-1 split. Stock A has a 2-for-1 split immediately after the close of X2, year X2. So December 31st, right after the close. You won't want to do it during the middle of the market while it's open, right? You make a mess out of things. So you do that after the market closes, the stock splits. And so now we need to make an adjustment for this divisor. Okay? So what happened? Well, let me lay this over for a second here. So what we're saying is, look, this stock is now worth 55. And so the stock is worth 55. And at the same point in time, the index here, right here, it's 59.33. So let's put this together. And the way we're going to do it is we're just going to change the divisor. So here we are. We're going to calculate a new index. Divisor, not an index value. And so we're going to say 55 plus 55, this is chopped in half, 50 plus 18, divided by D equals 59.33. This guy right here. We don't want the index to change just because of an accounting gimmick. Solve for D. And D equals 2.073. That's a 3 there. And so we have a new divisor. So then the divisor now is dropped from 3 to 2.0. And over time, with lots and lots of splits and other activity, the divisor has dropped off dramatically. So if you go to the Wall Street Journal, you can find the divisor. It's not this anymore. The D equals 0.147 approximately, and it changes periodically. Why? Again, because there's stock splits, and often there's stocks that come in and out of the index. And so there's a committee, like I said before, a committee that oversees what stocks that go in the Dow, for example. And periodically, some stocks get pulled out and others get put in its place. There are some people that try to make a business out of this. They try to forecast what stocks are going to get added and which stocks are going to get deleted from the Dow and the S&P, for example. And the reason for that is there are trillions of dollars worth of stock indexes out there, mutual funds and ETFs that mimic indexes. If the S&P or the Dow, for that matter, end up deleting a stock and adding a new one, they're going to have to take the stock to get deleted. They're going to have to remove that from its portfolio, which puts heavy downward selling pressure on that stock. And then they're going to have to replace it with the new stock. And that's going to put in huge upward pressure on that stock as all these mutual funds and ETFs are trying to buy that stock. So if you can predict which stocks are going to get pulled out and which ones are going to get put in, you can make a fortune. It happens periodically. Those boards meet and they make decisions. With that in mind, let's continue and look at what's called equal weighted index with this concept in mind. So with equal weighted indexes, believe it or not, they're equal weighted indexes. They're often referred to as unweighted indexes because every stock gets the same weight. And the way it works is this. The index tracks a series of stocks and they compute the return for each stock. And it's the returns for each stock that gets weighted and multiplied by the previous period's index price. So here's how it works. So with this portfolio we were just looking at right here, let's look at the return of stock A. And the return of stock A is simply take 110 divided by 100 minus 1, that's 10%. Return B is 50 divided by 50 minus 1, just a different way of calculating returns. That return is 0. Return C was 20 divided by 18 minus 1. I'll put the 0.0 there for you. And that equaled, oops, made a mistake. That should be 18 over 20 minus 1. And that equals minus 10%. So this is plus 10%, 0 change, and then minus 10%. Okay, we can put these numbers, we'll take these numbers for example, and we'll put them in an index. This will formulate it in the index math. Okay. So let me explain. This was the base period. This is basically K from the previous period. Think of this as K, or the beginning balance of the index, previous index value. This starts at 100. Remember I showed you with that. It's always going to start out at 100. Okay. Then the beginning balance starts out at 100. And so this is the previous balance. Then we're giving each stock here, this is gross return, sometimes without subtracting 1. It's a gross return. We're giving everything 1/3 of a weight. So it's all equal weighted. This is the 10% return, 0 return, and a minus 10% return. And so we do this calculation, we get 100. What? Yeah, we do. We get 100. And so what's happened is, look, we're giving 1/3 to a weight to a stock that went up 10% and 1/3 to a stock that went down 10%. Well, those two stocks cancel each other out. This one didn't change at all. The zero didn't change at all. So the index is unchanged. So what happened? Well, the price-weighted index said the Dow went up. This index, at least, if we assume this is like a Dow, it went up. The value-weighted said, no, it went down. And now the equal-weighted said it didn't change at all. So which one is it? Well, it turns out to be all three are right in some respect, given the price-weighted index. The price-weighted numbers are right. The value-weighted index, the value-weighted numbers are right. And equal-weighted numbers, the equal-weighted numbers are right. But ultimately, we want to ask, well, what's the most intuitive and best of the indexes? And I already referred to that as being the value-weighted index. Why? Because, look, the company C is the biggest company in terms of market cap, and that lost 10%. A gained 10%, but it's a small company stock. What mirrors the economy the most and has the most influence on the economy? The value-weighted. So that's why economists and finance people look at value-weighted indexes. They put more, I don't want to say it, but they put more weight on value-weighted indexes than they do other indexes because of this point. Now, that said, in some cases in finance, there's financiers that want to often compare value-weighted indexes to price-weighted indexes, assuming they put an equal weight into each stock. So what this does is, think about it. A value-weighted index is a market cap-weighted index, and the stocks that have the most market cap have the most weight. So you have 500 stocks in the S&P 500. Those big companies, the Apples, the Microsofts, the Walmart, huge weights in those particular stocks, and stocks number 450 to 500 get very, very little weight. So it's not totally balanced out index. And what that has led to is the idea that, well, maybe there's a better way of doing this. Maybe here's a good strategy. Look, why don't we make the S&P 500, buy the same 500 stocks, but give them equal weights? And you know why that looks really cool? Because, look, small stocks tend to outperform large stocks. And with the regular S&P 500, it's dominated and the weight is towards large stocks. Why not tilt the portfolio so that the weights are equal? So tilt them away from the big stocks towards and more on the small stocks, all equal weight. That way, when small stocks tend to outperform the large stocks in the long run, then you'll have a better index. You'll have an index that kind of outperforms the index. You'll have an S&P index that outperforms the S&P index, and the reason is there's different weights. There are mutual funds and ETFs that do exactly that. And you got to be careful because sometimes the returns do pull apart and sometimes it works against you. So sometimes small stocks underperform large stocks. And when that happens, your performance is going to underperform and you're going to say, why didn't I just buy the normal S&P 500 value-weighted index? And then other people, they end up buying an S&P equal weighted. They don't even know they bought an equal weighted index. They don't even know what an equal weighted index is versus a value weighted. And so they just, they're scratching their head. It's like, wait a second, I'm reading literature and it says the S&P went up 10%, but my portfolio fell 10%. How can that be? Well, look at the weights. Look at the prospectus carefully. With this said, done, let's move on to the idea that you want to mimic, I'll keep this up here, you want to mimic an index. You want to mimic, say, a price-weighted index, or you want to mimic a value-weighted index, or you want to mimic an equal-weighted index. When I say mimic, you yourself want to buy the 30 stocks that are in the Dow. How would you actually imitate that index? How would you mimic it? Well, it turns out that if you buy an equal number of shares of each stock, so in this calculation, if you were to buy an equal number of shares of stock, then what happens is automatically, mathematically, the weights that are put on those shares depend on the price, because that's the only thing that's changing. If you have an equal quantity across the top for those shares, what's influencing the relative weights? Well, it's the price only. So if you want to mimic a price-weighted index like the Dow, you're going to buy an equal number of shares of stock for all 30 stocks. With a value-weighted index, you're going to buy each stock as the market cap relative to the market cap of the whole index. And so, looking at this index right here, this calculation, stock A, we're going to look at the value of stock A, which is 500, and we're going to compare it to this whole number right here, the entire market under that index. So it's 500 divided by this number, that's the weight. And then for stock B, it's this number divided by this. And for stock C, the weight is this number divided by this. And the weights will all add up to 1. So the weight of each stock is its market cap relative to the total market cap of the index. That's how much it gets invested. And with an equal weighted index, now an equal weighted index, you buy an equal dollar amount of each stock. And when you have an equal dollar amount of each stock, everything really boils down to the returns, like we showed here. And then it's just a matter of averaging out these returns to help calculate the index. Now, the question then becomes, okay, you assemble a value-weighted, an equal-weighted, and a price-weighted index. You've assembled them. What do we have to do after that? Let's think now. Is there any implications? Do we have to rebalance anything? Well, it turns out if we just do a buy and hold with an equal number of shares on the price weighted, okay, then what happens is your portfolio and the index itself will track each other perfectly, okay, in terms of just capital gains now, just in terms of capital gains. Your portfolio, by the way, should outperform the index by a little bit each year, by about 2%. Why? Because your portfolio is going to generate dividends, and the index doesn't capture dividends. So notice in all these calculations here, these are all indexes based on market caps and prices, and market caps are a function of prices and so on. There's no dividends in here, right? There's no dividends included in here, but if you buy a portfolio that's mimicking a price-weighted index, your portfolio is going to generate about 2% in dividends, which means you're going to have a slightly better performance on your portfolio than you do the index itself. So keep that in mind. What happens is you just do a buy and hold with a price-weighted index. You buy an equal number of shares and just let it ride. And for the capital gains component, the index and your portfolio will match each other. The same with a value-weighted index. You buy a value-weighted index based on the relative market values. Then the relative market values change over time in your portfolio, and they change in the index itself. They match each other. So what I'm saying in this is a value-weighted index, you assemble it by equal, or you put in weights according to their market caps. Then it's a buy and hold. You don't have to do anything after that, because the index itself and your portfolio itself, at least in terms of the capital gains component, will do well, and they'll match, is what I'm trying to say. Now with an equal weighted index, it's different. You put an equal dollar amount in each stock. Okay, that's fine when you assemble it. But now what happens? Well, think about it. You put it together, and as soon as you put together the portfolio, some stocks go up and some stocks go down. Well, as soon as some stocks go up in value and some go down, the weights have just changed. It's not equal. So if you have a stock that takes off, right, and goes way up, it's going to dominate your portfolio. The rest of your portfolio is going to be a small fraction compared to that stock that's taken off. So what that suggests and means to you as a portfolio manager is, if you want to have at least the capital gains component tracking the index, what you need to do is rebalance your portfolio periodically. Technically, you need to rebalance it every second that the market's out there, because things are changing. But that's impossible, and that's very costly. So what a lot of people do is they end up, there's a trade-off. They wait a while, and then they make adjustments. So they only make the adjustments when there's big changes in the market to change the weights that they have in each stock, so that each stock has an equal weight over time. So I did talk a little bit about tilted indexes. So keep in mind that if you want to track an S&P or a Dow, to be true, you need to have the right weights and all the stocks in the index. But you may have the idea that, wait a second, I want to track the index, but I want to be able to manipulate a little bit. I want to be able to tilt the portfolio in one direction and away from another direction. So you're managing the S&P 500, and what you do is you're just like, well, I don't want it to be market cap in banks. I think the banking stocks are really going to drag in the future. So what you do is you reduce the weights that you have in the banking sector. But if you do that, you need to take all the weight that you took off the banking sector, you need to put it on the rest of the stocks somehow, some way, because the weights have to add up to 1 or 100%. And if you don't do that and you're just holding cash, well, notice in these indexes, cash isn't in the index. Prices and stocks are in the index, not cash. So you need to, when you're doing a tilt strategy, keep in mind, keep the weights 100%. Let's move on to free-floating indexes and managed indexes. There are some indexes that are relatively small. For example, the NASDAQ indexes, which are value-weighted indexes, are tech-heavy. But what happens is over time, these indexes, they may only have 100 stocks, and 100 stocks is not that much. But for example, Apple has been in those indexes, and after a while, the market cap of Apple relative to the rest of the 99 stocks in the index, Apple just overwhelmed them. And so what happened was Apple's worth over 20% of the index. So that's not a very diversified index. So what the NASDAQ does, their committee, is that they have a whole write-up. You can find it on the web. It describes how they manage these indexes. And what they do is they change the weights. They reduce the weight on Apple. They have to put it on the rest of the 99 other stocks. And so somehow they manipulate and change the weights on all the stocks to get it away from Apple, to give Apple less weight. That's what we mean by a managed index. It's pretty much on its own, but there are times when the committee will look at the index and make adjustments to it. And a lot of those adjustments they have are formulated, and they have guidelines on how to do that. So they're not just making it up as they get into a meeting. The other thing you need to know is that there are free floating indexes out there. So a lot of indexes now are free floating, and so we need to address that. It's really not a hard concept. So most companies, I should say, have stocks where, there's a bunch of stock that just doesn't trade. It's not floating in the market, so to speak. So you may have a stock where 50% of the stock may be closely held by insiders, like the founder of the company and his or her family may have 50% of the shares, and only 50% actually trade in the open market. Well, if that is the case, it could be that it's very difficult for mutual funds and ETFs that want to mimic an index to get their hands on those shares, because there's not that many shares out there, because most of them are privately held. They're not trading. Well, that's a problem, because you want to reflect the shares that are floating around actually trading between individuals. And those are called free floating shares. So what the funds do, these indexes do, is they figure out, they have ways of calculating free floating shares and what shares are not free floating. And the capitalization is a function of the free floating shares of a particular company divided by the total index market cap of free floating shares. So it's basically this calculation here, like in evaluated, except the quantities have changed. These Qs are all free floating quantities, so they'll be reduced for each stock. So there you have it, a brief summary of indexes.